What up guys, how y'all doing? I hope you're doing great. Yeah, so we outside, we came to the financial center to have like a couple of meetings, you know. So during the meeting, like I took out my phone to take a trade on your USD. Usually when I'm outside, I don't even like a trade at all, you know. But with this trade, it was super simple because I spotted a very simple chart pattern in the market. So I was like, why not just make a video to show you guys how to do it, you know. Yeah, so stay tuned, let's jump right into it.
So before I break down the trade that I took, I just want to show you the pattern that I saw in the market before taking this trade. This pattern is called the flag pattern. So what is the flag pattern? The flag pattern is just a continuation pattern that when seen in the market, it indicates that the trend is just going to continue in the same direction, right? So for example, if the trend is going up like that, we have trend going up, and then we spot this flag pattern, it indicates that the market is just going to push to the upside to continue its prior trend, right? So we have a move to the upside, we have a flag pattern, price is just going to continue in the same direction as the overall trend. On the flip side, we also have the same thing on the downtrend. If the trend is going down and we see this flag pattern, it indicates that the trend is just going to continue to the downside like that. We have the flag pattern like this, indicates that trend is going to continue. So it's just a continuation pattern. So we have two types of these patterns. We have the bullish flag, which is found on an uptrend. We have the bearish flag, which is also found on a downtrend. The name flag is just the normal flag that you know, right? So this is the flag, this is you, and this is where you're gonna hold, right? So this is the pole, this is the flag. We have two components of this flag pattern. We have the pole and then we have the flag. So looking at this, this becomes the pole, this is the flag, and this is the continuation of the trend, right? This is the next pole. With the bearish flag, we also have this as the pole, we have the flag like that, and then we have the continuation of the trend. So those are the two components of the flag pattern, the pole and the flag. So now let's talk about the nature's theory of the market. The theory states that whenever price makes a move to the upside or we create an impulsive move, there is always a correction phase before the continuation of the trend, right? So this becomes the impulse, we have a correction phase, this is the next impulsive phase, we have the correction phase, the next impulse, the correction, and the impulse. This is the nature's theory. This is how the market moves. The market doesn't go in a straight line like that. No, the market moves in waves, right? So we have the first wave, there's the impulse, the correction, and the impulse. So with the flag patterns, we actually spot them during the correction phase. This becomes the pole. We have the flag section right here. This is the next pole. We have the flag section also right here. So the flag is spotted during the correction phase. So when we look at the bullish flag, we have the trend just going to the upside, right? So we have this trend going to the upside. We have this impulsive move, price correct, and then we have the next impulse. So with this flag, what we're gonna do is we're just gonna wait for the correction phase, and then once we see this flag pattern, this is just an indication that price is likely to break to the upside or break the flag and continue going in the direction of the prior trend, that is the uptrend. With the bearish flag, it's also the same. We have an impulsive move coming all the way to the downside. This is the correction phase. Once we spot this flag pattern on the downtrend, we can also predict that the market is likely to break to the downside and continue the trend. Now that we know the flag pattern and also the nature's theory, let's now talk about how to trade them. So we're going to have a systematic approach on how to identify these patterns. First thing that we need to do is we need to identify the trend of the market. As you all know, in trading, we have three types of trend. It's either the market is going to the upside, it's an uptrend, or a downtrend, this is a lower low, lower high structure, or the market is just moving sideways, right? And since we are talking about the flag is actually a continuation pattern, which means it continues the trend. So our focus will be on the trending market. We're gonna ignore the sideways market because with this market, there is no trend. The market is just moving sideways and this is not a trend. The trend is very important to us as traders because the trend gives us the direction of the market. If you go outside and you stop a taxi, once you get into the taxi, the first question the driver is going to ask you is, where are you going? Why do you think the driver is asking you this question? Because without your direction, he can never move, right? So direction is very important for us as traders so that we can also know what we'll be looking for once we spot the trend of the market. So let's first talk about the uptrend. With the uptrend, we have price just creating a high low. This is an uptrend. Now on an uptrend, what we want to be looking for is buying opportunities because price keeps on going up, right? When we buy at a certain price and price goes up above that price, we make profit. If we buy at 5 and price goes to 10, of course we make profit. So when the price keeps on going up, we want to be looking for buying opportunities. But here is the thing, when we are buying, we want to buy when the price is low. If there is a product that sells at $100 today, and if you know that this price is gonna drop to $20 tomorrow, I don't think you'll be interested in buying today, because today the price is 100, tomorrow is gonna be 20. You wanna be looking for buying opportunities tomorrow because the price is low, right? So when we are buying, we always wanna buy when the price is low. So on the chart, let's just say this is price 5, this is 50, price drops to 20, right? It goes to 100 and comes to 70. Here, if price is at 50 today, and you know for sure that price is gonna drop tomorrow to 20, I don't think you'll be interested in buying at this level. You wanna wait for price to get here before you buy. So right here, you will not be looking for buying opportunities. This is the area you want to be looking for buying opportunities. When price is 100 and you know for sure that price is gonna drop to 70, right here you are not interested in buying because price is too high. When you are buying, you wanna buy when price is low. So you wanna wait for price to drop and then you buy right here, right? So if you look at the current price, if you wake up today and this is the price, you don't want to be looking for buying opportunities here. Why? Because price is too high. You want to wait for price to pull back and then you look for buying opportunities somewhere here. So if you look at the trend, we can identify that this is the push up phase. This is where the price goes up, right? And at this level, this is where the price pulls back. So this is the pullback phase. This is the impulsive phase, right? This is also the pullback phase. This is where the price pulls back before continuing the trend. So this is the continuation of the trend. Price just pulls back right here and then it pushes to the upside. So if we are buying, we are interested to buy at the end of the pullback. This is the pullback phase. We want to wait for price to pull back and give us a sign that price is going to the upside. We want to jump in right here and move with the trend. So we are only interested in buying at the end of the pullback. So if you remember the nature's theory, this becomes the impulse. This is the correction phase, right? This is the impulse. This is the correction phase. And the correction phase is where we spot these patterns. So the pattern helps us to identify that, okay, we are in a pullback phase. The impulsive phase is about to resume. So we need to start looking for buying opportunities. On the flip side, this is on a downtrend. We have the same thing. What we want to be looking for on a downtrend is selling opportunities. But when we want to sell when the price is high. If you have a shop and then you have a product that sells at $50, if you know that this product value is going to increase to $100 tomorrow, I don't think you'll be interested in selling your product today, right? Because if somebody comes today, the value is 50. But if the person comes tomorrow, the value will be 100. So here you are not interested in selling. You'll be interested in selling at this price, right? So you want to sell when the price is high. So on the trend, if this is price 100, price drops to 50, and then it goes up to 70, it drops to 20, and then it goes up to 30. Right here, I don't think you'll be interested in selling your product for 50 if tomorrow the price is going to go to 70. So this is the high of the trend. This becomes the high of the trend. This is too low. You don't want to sell here. You want to wait for price to pull back. This is where you want to be looking for selling opportunities. This is too low. You don't want to sell here. If you know price is going to pull back, of course you want to wait for price to pull back and then you sell here. So if you wake up and this is the trend, I don't think you'll be interested in selling at this level. You want to wait for price to pull back and then this is where you'll be interested in selling. So on the downtrend, this becomes the impulsive phase. This is where the price pulls back. This is the correction phase. This is the impulse. This is the correction phase. This is the impulse, correction, and the correction phase is where we are looking for these flag patterns. The second thing that we need to identify is the market phase. Is the market in an impulsive phase or we are in the correction phase, right? So once you identify the trend, that is step one. Step two, you want to identify the phase of the market. If the market is in an impulsive phase, then you want to wait for the market to come back to the corrective phase. Because at this level, you don't want to be looking for buying opportunities. You want to wait for price to pull back and then you look for buying opportunities. If the market is in the corrective phase, this is where we want to identify the flag patterns. So now let's talk about how to identify these patterns. On the uptrend, what I'm looking for is the bullish flag, right? So this is the rule that I've established to identify my bullish flag. First, I want to see the impulsive move, right? And then secondly, I want to see price pulling back. Once I see this move down, I establish this as my first point. What I'll be looking for is for price to push to the upside to create a lower high, right? So I want price to create a high, but lower than this high. So I want something like this, and then the price just goes down. So here I'm just gonna connect the first high, the second high like that. And what I also want to see is a lower low, which means I want a low that is lower than this previous low, right? So a new low and then a move to the upside. So I can also connect my first touch right here and then the second touch. So this becomes my impulsive move. This becomes my flag, right? So price is just going to range in between these lines until I see a breakout. Once I see this breakout, this is just an indication that this flag pattern is over. Price is about to resume the trend to the upside. So with this bullish flag pattern, how do we even trade it? We trade it just by waiting for the breakout. We wait for the breakout like that. Once price closes above the resistance trend line, we can actually get into this trade. There are more varieties to this. We have the first touch, second touch, third touch. Even within this pattern, we can also view the market structure just by looking at the lower lows and lower highs. This is actually an advanced level to these patterns, but this is just a simple way of trading this pattern. So we will just wait for the breakout, enter right here, put stop loss at the lowest level where the market reached before breaking out. And then with the take profit, what we're going to do is we're going to measure the distance of the previous pull, right? So we're going to measure this distance, the first pull, and then we bring it at the breakout, right? So this is where we will be looking to take our profit, or where we are anticipating that the market is likely to move to. So once we get in here with our stop loss here, this is going to be our target. First thing that we need to do is to identify the trend of the market. And as you can clearly see, this is actually a downtrend. But what you also need to understand is you need to be able to read market structure. Looking at this structure carefully, we were on a downtrend, but the trend has actually shifted from bearish to bullish because the higher low has been broken. This was a lower low, lower high, lower low, lower high, lower low. This high has been broken, so trend has shifted. So we are now on an uptrend. And on an uptrend, we want to buy low, right? So if we see a push to the upside, we are not interested in getting in right here. We want to wait for the pullback and then we get in somewhere here with a move to the upside. So looking at this example, we have this impulsive move. We just want to wait for the correction and then we get in. So let's take a look at how price is going to play out. Here we have our first point, right? This is where the market got to before pushing to the downside. So this is going to be our first point. We want to establish a second point. We don't want the second point to close above the first point, which means we want a lower high, right? So I can draw my first point connecting my second point, and what I'm looking for is also my structure below, right? So right here I can also connect to this first point, the second point, and I have my potential flag pattern. So what I'll be looking for is just the breakout of this flag to the upside. Once I spot this, I'll just go in for a buy. So let's take a look at how this is going to play out. Let's just extend this, right? We just keep on correcting. This is the impulsive phase. We have the correction phase. Let's take a look at this. This is the breakout, right? So you can see the candlestick closing above this resistance trend line, and this is an indication that this correction phase is over and we have the impulsive phase resuming. So right here we'll be looking for buying opportunities. We will get in here with a stop loss just below the lowest level the price got to before breaking out, and with our target, what we're gonna do, we're gonna measure the distance of the previous pull. So we're gonna measure from here to there and then bring it at the breakout. So this is where we'll be looking to take our profit right here. So let me just delete this and let's see how this is also gonna move. We have price just hitting our take profit, right? So this is just the simple way to trade these patterns. One thing that you need to bear in mind is you're not gonna get the same pattern with the same shape of candlesticks. In trading, every price action is unique. If you read the book written by McDouglas, Trading the Zone, it says every price action is unique, right? But the structure remains the same. It's the same concept, it's the same structure, and then it's the same approach to this type of setups. Let's take a look at another example. So this is an uptrend. We have a big move to the upside. This is an impulsive move. What we are interested in is buying opportunities, but we are not going to buy here, right? We want to wait for the pullback, then we get in somewhere here, and then we move to the upside. So let's see how price is also going to pull back. We have this move. Price makes a new low, right? So we can establish this as our first point where price actually pushes to the downside. Let's see if we're gonna get our second point. So price gives us our second point right here, right? So we're gonna connect the first point, we have the second point, we also have this first point, we have the second point, right? So this becomes the impulsive phase, this is the corrective phase, and what we will be waiting for is the breakout of this flag pattern. We're gonna be looking for buying opportunities once we get this breakout at this level, right? So let's just see if price is gonna break out from this level. We have this price just breaking to the upside like that, right? So our entry would have been here, our stop loss would have been here, and our take profit would have been the measurement of the pole from here to here. We're gonna bring it at the breakout, right? So this will be our take profit level, exactly where the price got to, right? So let's just see how price actually moved, right? So this would have been our take profit just by spotting this impulsive phase, the correction, and also the impulse. And if you want to take another trade, that is, if you want to buy, we are not interested in buying at this level. Why? Because this is a high, this is a low, this is a high. This is too high. We don't want to buy here. We want to wait for price to pull back and then we buy. So let's also see how the price is also going to play out right here. We have our first point right here. We have our second point. So we're going to connect this. We also have our first point. We have our second point. So this is a valid impulsive move and a correction phase. So same approach, we will be interested in buying opportunities once this flag pattern breaks to the upside, right? So this is where we'll be looking for buying opportunities at the breakout of the flag pattern. Then our stop loss will just be below the lowest level that the price is going to get to before breaking out. So let's see the lowest level. This might be the possible lowest level, but we need to wait for the breakout. So let's see. Okay, so we're still in the correction phase. Price makes this move, right? We're still waiting patiently for the breakout. So we might have a possible breakout here, right? We're not going to enter in this corrective phase. Here you want to stay out because price is just correcting. You don't want to have any business in this phase. What you are interested in is catching the move to the upside. Right, so at the breakout of this flag pattern, we would have been in this trade with our stop loss just here, and then our take profit would have been the same measurement. We're going to measure this pole and then we bring it at the breakout level. So this is going to be our take profit level. Let me just delete this. This is our take profit level. So let's see if price even going to get to our take profit. Okay, boom, price just smashes our take profit, right? So it's the same approach that we did for this and that, just by spotting the impulsive phase and the corrective phase. So if I copy this price action, right, and I bring it here, what is the difference? Can you see any similarity? It's just the same structure, right? But if you look carefully, the candlesticks are not the same. The nature of the structure is not the same. This moved down, it moved up. This also moved down, moved up. But the candlesticks are not the same. They move in a different way. That is why I'm saying each price action is unique, but the market structure remains the same. The same approach that we're going to have, the same system that we're going to repeat, but we're not going to have the same candlesticks. If we should scroll back, let's just take a look at this. You can see right here, this is also an impulsive move. Price just gave us a correction phase right here. And then what happened? It just broke to the upside. Even on the small scale, we have this impulsive move right here. We have this small correction and also an impulsive move, right? So you can see how the market keeps on repeating itself. So let me just copy this price action. We will just copy this from here to there. Let's put it somewhere here. Let's also copy this small price action from here to there. And let's also bring it here, right? And also I'm going to copy the one that we just took, this one. I'll put it side by side right here. And I will also copy this last one. Now, let's put all these four price actions together. You can see the similarities, right? But they are all unique. The candlesticks are different, but the structure remains the same. We have this impulsive move, correction, impulsive move, like that. We have this impulsive move, correction, and impulse, right? Like that. You can see how they are just repeating themselves, but we have different variations and different candlesticks when it comes to their individual structures. On the downtrend, how I identify my bearish flags is the same thing, but the opposite, right? So I want to see my impulsive move to the downside. I want to see price pulling back, so this becomes my first point. What I also want to see is my second point, right? So I want to establish my first point, my second point. I also want to establish my first point, my second point at this level. So my entry will be the breakout of this flag pattern. My stop loss will just be the highest level price got to before breaking out, and my take profit is going to be the same. We're going to measure this and then bring it right here. So now I'm going to break down the trade that I took whilst I was having the meeting, right? If you look at this structure, this is a downtrend. That's why I said you also need to master the market structure. We had a high, 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 low, high, 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 low, high, 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 low, high, high, but price has taken out this low, so we have a change of character. This is no longer an uptrend. So what I'm just looking for is selling opportunity. So I'll go down on the lower time frame and show you what I spotted. So on the lower time frame, this is a downtrend, clearly you can see, and when I'm selling, I want to sell high. This is a low, this is a high, this is where I would have sold, but currently price has created a low, right? So if I want to sell, yes, we are on a downtrend. If I want to sell, this is not where I'll be looking for selling opportunities. I want to wait for price to pull back before I get this opportunity to the downside. So let me show you exactly what I saw before taking this trade. At this current price level, this was in the night. This wasn't my trading session, so I was not even looking at the market at this level. When I woke up, this is what I saw. So I'm just going to fast forward it to my trading session. When I woke up, this is what I saw, right? So I saw price just pulling back, and the pullback phase is what interests me because I want to be selling high, which means I want to be selling at the end of the pullback. So I saw this, I established my first point, my second point. This was my first point right here. This was my second point. Someone may ask me, why is this not your second point but this, right? That is why I said you also need to master market structure on different time frames. I'm looking at the pullback here, but I'm also looking at the market structure right here on the lower time frame. This is a high, 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 low, high, high. I'm not going to sell this because the trend line broke. No, the market structure on the lower time frame here is still an uptrend. I'm still looking for this uptrend to shift to bearish. So this, yes, was my initial second point. But when I saw this and I saw this push to the upside, this became my second point. So right here, I have my first point, my second point established. I also have this level right here, and I'm looking at the market structure within this structure. As I said, this flag patterns has to do with a lot of things. It's not just what I'm showing you, because I cannot just use one YouTube video to explain everything to you, right? But this is just the basic. So what I was looking at is the break of this pattern. I saw a double top right here, and then I saw a breakout right here, right? So let me show you exactly where I entered the market. This candlestick actually gave me the entry. So I got in right here with my stop loss here, and then my take profit, I measured the distance of the pole and I brought it right here. So this was my take profit level. Let me just bring my take profit here. Let's see how this played out. So this was during the meeting. I just took this trade and I put my phone away. After the meeting, I just saw price just coming down right here to hit my take profit. So this was a very simple trade just by understanding how to trade the flag patterns. I hope you got something valuable from this video. Just a recap of everything that I explained. First, you have to identify the market trend. Secondly, you also have to identify the phase of the market, right? And thirdly, you have to wait for the pullback phase. Once you see the pullback phase, you also have to wait for the breakout of the flag pattern. And once you get a breakout, make sure you set your stop loss and also your take profit. If you actually learned something, don't forget to subscribe, like, and share, and I'll see you in the next one.